Good evening, everyone, and thank you for joining us. My name is Stacy Varghese, and I am the Associate Director in the Office of Advancement at St. John's University. Today, our special edition series on small business continues. John Ceparano and Karl Graf are our panelists this evening, and they will discuss year-end tax planning now. Some housekeeping rules before we begin. If you have a question, please submit it on the bottom right in the Q&A section to panelists and hosts, and they will be answered throughout the fireside. For the full experience of today's webinar, we ask that you choose the side-by-side view. You can find this option on the top right of your screen. As a reminder, please make sure to keep yourself on mute. Lastly, a recording of today's session will be emailed to you after the presentation. Now, I'm excited to introduce our speakers. John Ceparano is a principal and wealth manager at Madero Wealth Management, LLC. As a wealth manager, he has had the privilege to provide advice to high net worth individuals, families, businesses, nonprofit organizations, and fiduciary clients in all areas of their investment and wealth management need. John has over 25 years of experience in financial planning, taxation, business consulting, financial counseling for business owners, and serving high net worth individuals. Karl Graf is a principal and wealth manager at Madero Wealth Management, LLC. His main responsibilities including helping clients developing their financial plans, implementing wealth management strategies, and managing clients' investment portfolios. Karl has extensive experience working in all areas of financial planning, including retirement planning, estate planning, tax planning, and risk management. He has more than 21 years of experience in the wealth management profession. Karl is a certified public accountant, personal financial specialist, and holds a certified financial planner certification with broad experience in financial counseling and wealth management services. He has been certified by various courts as a financial expert and has provided such testimony in court on several occasions. Welcome, John and Karl. I will hand the webinar controls over to you now.
Thank you, Stacy. It's a privilege and an honor to be working with St. John's, my alma mater, for a number of years doing these types of presentations on various subject matter. This is our second session of a 5-session series regarding helping small businesses become more successful. If you listened in last month, we focused on leadership and skills that will help the small business owner take more control of their own business and its direction. We also talked about helping them find and retain the best employees for their business model, as well as maintaining and retaining their best client base and how to identify those so that they don't throw you off course, the old 80-20 rule. Today, though, in our second session, we'll be talking about the areas on your screen right now, which are focused on year-end planning, planning for next year, bolstering business success, and what retirement plan is best for you now and in the future, and knowing when to change. Both Karl and I started out our careers as CPAs and have been serving small businesses owners in many capacities. Both Karl and I love taxation, not like most maybe, but it is something that is a thread through everything that we recommend. It may not dictate what we do, but we want to know the ramifications of making any of the decisions and in which way taxes can be minimized so that the hardworking small business owners such as yourselves can retain that not only for your business's growth, but for your own personal wealth. Keep in mind, many small business owners like yourself find their personal wealth integrated with their small business and how well it does. And it includes planning not only for taxes, but the management of the risks. Some of the risks in being in business in terms of its continuity and its value relate to if you die while you're still working, if you become disabled, if there's any lawsuits that come around because of claims against your firm or any of its employees, and keeping cash levels in the business to facilitate operations for a reasonable period of time. This year, like no other, has put a lot of stress on many small business owners, as we know. Some have done not done very well at all due to governmental restrictions on operations, while others have thrived due to the demand based on what kind of business that you're in. This is why we work closely with our wealth management team and the other professionals that you typically need, such as your CPA. We, both Karl and I, are CPAs, and because of that, we speak their language, the CPAs. And with that, we've tried to translate that into the accountant speak into layman's terms so we can help you understand the coordination of these things. Karl right now will be talking to you on our first subject matter about year-end tax planning and giving you tips along the way here about what things you can implement now between now and the end of the year. Karl?
Thank you, John, and welcome everyone. I appreciate the opportunity to speak to you today. Before I begin on tax planning, I do want to point out something that we'll reiterate at the end of the session, and that is Modera has a dedicated page on our website which offers free resources to attendees of these sessions. Right now there are a couple of free documents up there, but as we go through each session, we will be continuing to add additional resources there, and we invite you to visit that. Things you could download, things that I think would be actionable and helpful to you as you continue to manage your business. So year-end tax planning. Year-end tax planning means gathering your current data and trying to project your year-end results, and beyond that, projecting into 2021 as best you can based on information that you have, sales that you could anticipate, perhaps new contracts. This year, as John said, is really exceptional due to the pandemic. Many businesses probably had a difficult time, and so you might anticipate next year hopefully being more normal and maybe even making up for some of what you didn't make this year. So much tax planning is really around timing, and that's a lot of what I'll be talking about. If you have an opportunity to defer income, perhaps by putting off a new project till the beginning of next year, if that's possible, or accelerate tax deductions if you've got the money, again, to make a big purchase in equipment or software or something, you could accelerate it this year or defer it to the next year, depending on your circumstances. One of the ways to help you decide that, in a very important way, is to know your tax bracket. That information probably is best obtained by working with your wealth manager and CPA. Most of you, we presume, are in the type of business that the income flows through the business and is taxed to you on a personal return, which would be a sole proprietorship, an S corporation, or a partnership. So we're going to be talking about personal tax rates here. So not only knowing your tax bracket, but where you are within the bracket is important. If you're on the upper end, lower, etc. And I'll illustrate that by putting this chart up. We're going to focus on the married filing joint column, where it's the blue highlight, and particularly on the 24% and 32% brackets. You can see there's an income range there, and for the 24% bracket, it is quite broad. It is about $155,000. And for the 32% bracket, it is $88,000, roughly. Now, these concepts will apply to you the same whether you have a different filing status, and whatever your tax bracket is, you can see the list over on the left. But just for purposes of this conversation, we'll focus on those two. So let's say your income is just a little bit below the limit on the 24% bracket, say $320,000, and you've got a new project beginning between now and the end of the year that will add about $60,000 or $70,000 to your bottom line. That would put you firmly into the 32% tax bracket. Now, you may consider taking the opportunity, if it's possible, to put that off to next year so that you can keep your income within the bracket where you are now at 24%, because it's a pretty big jump and a fair amount of dollars that would be taxed at the higher rate. Conversely, if you have expenditures that you need for equipment and the means to finance them or to purchase them, you may accelerate those purchases to, again, reduce your taxable income to try to maintain your tax bracket at a lower level. If this year has been difficult for you, as for many companies, it might not make sense to accelerate a purchase, because if you return to a more normal year next year, you're likely to be in a much higher tax bracket, in which case the deduction for whatever you purchase will be more valuable for you next year. Of course, we're just talking about the rules as they are, and of course, given the situation with the elections coming and everything, everything could change, but we have to work with what we know is right now, and that's what we're discussing, although John will talk about some of the other possibilities a little bit later. So to accomplish these kind of things and to really be able to evaluate this in a sound fashion, it's really important for you to have a team of professionals that works well together and communicates clearly. Most commonly, of course, the CPA is the backbone for pretty much every business owner, but also a wealth manager if you have financial planning assistants. They should be able to communicate well and work together on your behalf. And that's where you really get the benefit, because without great communication between the professionals and yourself, opportunities can be lost, mistakes are more likely to happen, and gaps in planning can persist. So making sure the professionals are talking to each other is a very important factor, and this is a responsibility that we take on as wealth managers and as CPAs, as John and I both are, so that relieves the business owners that we work with of some of this responsibility so they can focus on running the business and improving the business. We go through the coordination process, arrange the meetings and planning with their other professionals to minimize the possibility for gaps in planning. This is a significant value add for our clients, and we believe that you should be able to avail yourself of that kind of a service too. In addition to tax planning, John is going to speak a little bit about maintaining and achieving the proper cash flow, a cash level in your business. And with that, John, I'll turn it back over to you.
Thanks, Karl. This subject matter, can get very technical, and we'll do our best to keep it as light as possible. But this is serious matters, especially at the end of the year, in a year that has been very stressful, no matter what your business situation is, whether it's struggled or struggled with cash and being closed down, shut down, or it has struggled to try to keep up with demand because there has been a high demand in your particular area. Either way, maintaining the proper cash flow is critical. And this would have been long before a crazy year like this. I have coached and helped many small businesses over many years to determine what their right cash balance should be in their accounts. For example, in our business model, we're in a financial services business, which is like, in many cases, many service businesses. We try to keep at least 2 months cash flow on hand. We also have established a line of credit for things that maybe come up that are unexpected. So if we had that amount, and that was good for at least three to 6 months worth of cash flow, there is typically no cost or minimal cost to have that line of credit available to you. But of course, like most things in life, especially with banks, you are able to get these kind of lines of credit when you need it least. So this may or may not be the best time to get that line of credit if you don't have it, but it will help you in the future when it is the appropriate time for you, because should these matters happen again or something similar, you will have those resources when you need it until you can get back up on your feet. So determining the right cash levels is about finding out whether you have, what's too much, what's too little, and what's just right. It's like the story of Goldilocks here with this, knowing what's the best amount. Well, if you have too much cash in your business, you might be exposing yourself to claims of creditors if there was ever a lawsuit. Or if you have too much money in your business, it could be making you money in some form of investment. Not necessarily volatile, but just something that makes you something more than sitting in a checking account, which basically in all business accounts is earning you very little, if anything. And then, of course, there's always the opportunity to use that excess cash to max out your retirement plan contributions. But we'll talk about that a little bit later. If you have too little in your accounts, that can cause a lot of problems in many ways. One, you might be just taking too much in distributions. And what it does is it makes you scramble for cash, especially when you have things tied up elsewhere or did not keep that cash liquid in other resources. And it creates stress, not only at home, but it also will create stress for your organization. Because if you do have the right levels of cash, just let's say 2 or 3 months worth of cash to cover your expenses of your business, everyone at home will be happy because you're not taking money out of the budget for the house. And so will your staff and vendors because you're not missing payrolls, you're not being late on payroll taxes or sales taxes if that's your business model. So this is a sign of a strong leadership and foresight. Let's turn to some other matters. Carl already talked about coordinating things with professionals. So sharing information with your professionals is critical. Your professionals are there to do their job, and their job can only be best done if they have information and communication. It goes 2 ways. You have to find consultative professionals that will work with you, not just ones that will just do the minimal that they need. There are CPAs out there that are just focused on tax season and others that are focused on working with you throughout the whole year. If they're working with you throughout the whole year and coordinating with your wealth manager who know you very well because of the many other areas they cover, they'll be focused and coordinating with all three would be focused on estimated tax payments, not overpaying and giving the government a free loan, and not underpaying and be subject to penalties unnecessarily. They can also keep you up to date on retirement plans, what deadlines are. Deadlines for retirement plans depend on the type of retirement plan you have. We'll be talking about that later in the session. And knowing how tax law changes could impact the next, changes can be so there's many opportunities to change. Carl now will talk to you in much more detail about specific year-end tax plan that you can take advantage of right now. And this year has been like no other. Carl, give us some of your insight here. I know you've been thinking about this.
Thank you, John. Thank you. Yes. As you said, this has been a year like no other, and I think for most of us, or many of us, it's one we hope we never see anything the like of again. Certainly as a result of the pandemic this year, many, many businesses have struggled just to keep the doors open, much less be profitable. But unexpectedly for some, they've done exceptionally well, which has its own problems, but of course those are probably problems you'd prefer to have. So what I'll be talking about apply equally is be like 2 sides of a coin to either situation. If you've had a difficult year, as we talked about again, much tax planning is about timing, then you can hold off, if you can hold off on expenditures until next year. Again, the tax deductions will probably be worth a lot more money next year when you have a more normal business year and when things pick up again. Likewise, if you've done really well this year, you may want to accelerate deductions where you can. That includes purchasing equipment, things of expansion, as well as looking at retirement plans, which John and I will go into great detail later on. Preparing a tax projection with your CPA to take another look at your estimated tax payments. I think John mentioned this briefly a few minutes ago, but the fourth quarter estimated tax payment is due in January of 2021. There's a safe harbor rule that most CPAs build in when they calculate estimated taxes, and that is 100% of the prior year tax if your income is below $150,000, or 110% of the prior year tax if you're above that. So if we assume you're above that and you've had a year that's been a struggle from an income point of view, if you pay your 4 estimates at that rate that the CPA calculated last year, you could very well significantly overpay your estimated taxes, and that cash is precious to you. So it's important to have your tax planning updated so you can figure out what your tax liability is likely to be and adjust your fourth quarter estimate accordingly. You may not even need to pay one. So that can help preserve cash and get you through these difficult times. On the other side, if you've done really well, you would want to make sure you get that safe harbor. If you wanted to pay estimated taxes and have a safe harbor based on 2020's income, then you're required to pay 90% of your tax bill in the form of estimates to avoid penalties and interest. So there are some options there, and I think most people, or many people, don't really think it through all the way and inadvertently overpay, especially in a year like this. Again, if you've been very profitable this year, tax projection is important, not only for the estimates that you make, but so that you can have a handle on how much you're likely to owe when you file your tax return next spring or next summer if you extend it. It's important for that so that you can provide for that cash and set it aside in a timely way so that you don't get caught with an potentially unexpectedly large tax bill, which is very upsetting if you're not aware of it. So knowledge is power, and use your CPA to help you gain the knowledge and more insight into your business so that you can manage your estimated taxes. Next is not exactly a tax planning situation, but it is related to that and related to this year, and that's the impact of the PPP loans, which many businesses applied for and many were able to obtain earlier this year. Of course, the big lure of that was quick cash and also potential forgiveness if you spent the money on the appropriate expenses. The problem that's arising and frustration that has arisen is that the final regulations on determining how much is going to be forgiven and when have not been finalized yet. For lenders, this is very frustrating, as for business owners too, and the Small Business Administration has not come up with that yet. There have been a lot of suggestions from people in Congress, and one which is prominent and may be of value to a lot of small business owners is that PPP loans of $150,000 or less could be forgiven if the business owner attests that the funds were spent on expenses that qualify. Now, most loans by volume were made for $150,000 or less. So this could certainly reduce the backlog, make life a lot easier for both lenders and for small business borrowers. Hasn't come to fruition yet, but we're hopeful that something like that does come about because it will eliminate a logjam and resolve a lot of these issues very quickly. If, again, timing issues, if it's a difficult year, you want to keep your cash as best you can and not spend it. One other form of taxes I wanted to touch on, and that is payroll taxes and sales taxes, which businesses need to withhold from their employees or collect potentially from customers. You, as the business owner in that case, are acting as an agent for the government, and it's your job to remit those funds to the government quarterly or in a timely way. Payroll taxes, of course, can happen much more frequently. Many business owners have fallen into a trap when cash is tight in withholding taxes, payroll taxes, and hanging on to them, telling themselves, this is just a short-term situation, I will catch up a little bit later, and all too often they never catch up. The problem with that concept is it's not really your money. You are holding employees' money, and your responsibility is to remit it to the IRS. So pretty much at all costs, make sure you file your payroll taxes on time and sales taxes, because they'll come down very hard on that because, again, it's not your money that you would be withholding. Last aspect of this is, of course, retirement plans. If you've had a very good year, you probably want to think about putting some kind of a retirement plan in place. There still are opportunities for the rest of this year, even though certain plans, as John mentioned briefly before, the deadline for getting them in place was today, as a matter of fact. But there are other options that you could avail yourself of, and John will focus on those in the next section or later on in our presentation. With that, we'll move to more general business conversation and how you can bolster business success. And with that, I'll turn it back over to John.
Issues we can address, but there's only so much time. So today on bolstering business success, I want to talk about a couple of key issues here, and this relates to a little bit of your roles as an owner and key personnel. One is to bolster your business success. It relates to your leadership skills and managing. As you start out as maybe a cheap cook and bottle washer in your small business like we all have. I started out on a card table many, many years ago. My wife became my first employee when the kids wound up going to school, and then it took off from there. And it was from trying to get people to work in a very small business environment, making sure that they didn't have issues with OSHA and having too many people in a small location. So the struggles of a small business I'm well aware of, and applaud you for making it through to wherever you are today. But some of those roles are about, as you mature in your business, is scheduling your time to make time to manage your business. And you should be thinking about doing that on a weekly, monthly, and annual basis to reflect upon how well you're doing and where the trends are going with that. For example, I take every Friday morning uninterrupted to spend some time on business development, and that may mean helping people understand how to do public speaking, mentoring people, working on staying in contact with many of the professionals that I work with and how I can help them, and it comes back to you. As well as looking at things that are going on in our business. In our business, as it's grown, we've broken things down into various committees, and one of the committees that I've gotten involved with is our budgeting. So I do get involved in looking to see what our trends are. And that leads us into the second thing beyond scheduling time, to making time to set aside uninterrupted for a couple of hours or whatever, or, a portion of the day. It's better than doing it for most people than at 8 or 9 o'clock at your dining room table when you're exhausted. But everybody's either better in the morning or better in the late part of the day. It all depends, whatever works best for you. But the part that I was getting at was reviewing your operations. What you want to do is see what the trends are. Look at it from a week-to-week basis, month-to-month basis, whatever your accounting mechanism is, or quarter-to-quarter in some cases. And what you want to be able to do is, and by the way, not beyond a quarter, because then you will never have time to recoup during the year. So whatever is your frequency that you can see the trends in your business of what things are going well with sales. So if you saw things going well in your business with sales or revenue, depending on what type of business you have, you want to support those things, prop them up, make sure that they continue. Try to identify what changed that increased those revenues, or quite frankly, what slowed them down, what caused them to go down. I'm not talking about seasonal things between summer and winter, or summer and fall and spring and things like that, like maybe in a retail establishment that does most of its business during the Christmas time, holiday times here. But it is about monitoring what works and what didn't. Many small businesses, when things are getting a little bit tough, or they think they are, maybe part of that in terms of sales is because they haven't continued planting seeds throughout the whole year. Maybe it's because they slowed down or didn't think their marketing was changing. Maybe they need to get that with a marketing group, or maybe you need to get some great ideas from your own employees that can help you, that maybe you've had some experiences before. And then more importantly, monitor where those revenues are coming from. Are they coming from referrals? Are they coming from marketing campaigns and newspapers, ads, radio, whatever it is? Find out what works. The funny thing is that whenever you have some kind of marketing plan, things that work today won't necessarily work in the future, and vice versa. So it does make sense from time to time to try different things. So you need to find what's most effective for you and then bolster those things up. On the other side of things, what if you see that things are going down or there are some expenses that could be happening? I'll let Karl tell a quick story about how we went to our office about 2 weeks ago, and we could have uninvited, because we've been working mostly from our homes, found out that our water bill would have been rising. Why did that happen, Karl?
Well, John, it's not only the water bill would have been rising, but we could have wound up flooding out the office next door. Our refrigerator malfunctioned, and there was a huge puddle on the kitchen against the wall abutting the space next door. We do have presence in the office once in a while, but I came in, I happened to look in there, and fortunately we were able to stop that before it became a big problem, but it could have been. And it turned out to not be much, but if it had been unseen or not discovered for a long time, who knows what could have happened. So it is important to check on your equipment and check all aspects of your physical plant to make sure that everything is in working order at all times.
Thanks,
Carl. You, John.
Well, there's other things that can happen. If you're in a business that has, for example, things that come up once every year, such as like insurance renewals, and you might find out that if you're not paying attention, that your insurance costs may be going through the roof. Just recently in our own firm, or just this past month, and we go through this once a year, we review our health insurance for our employees. And we found out that we had to get some different competitive bids because of pooled health insurance plans will be based on the claims that they had. We had a couple of people that were pregnant and had claims or had some illnesses or whatever the story was. It does affect their overall rates. So shopping around from year to year, getting competitive bids keeps everybody honest and will help you out in the long run. Tracking the trends of those expenses is also very important. You may be deceived to find out unintentionally that something that happened in January that you saw happen in December might not be that much. And if it slowly goes up very little, over the course of 6 months to a year, things can be going up at a much higher percentage if you don't keep track of those things. So just be aware of what those are. Try to take corrective action as soon as possible when you see those trends changing. Don't just go month to month or quarter to quarter. Look at them over a longer period of time. Next thing is let's talk about as it relates to cash flow and planning for the future is setting up a sinking fund, which basically means, like at home in years past, people used to set up like a holiday bank account or a Christmas club or whatever it is. Put that money aside so that when those big purchases are needed or anticipated for keeping up with technology, whatever it is, those funds are available. This goes back to something I said a little bit earlier, knowing how much you have in cash reserves. This is part of the budgeting process. You should not be shocked when things happen. Every once in a while, there are things that come that are unanticipated, but that's why you have reserves for those unintended circumstances. So set some money aside for equipment, vehicles, software, computer obsolescence. We're in a world today like everybody's experienced right now, one way, shape, or form over the last 6 months, and how we have had to communicate through meetings like this, Zoom, Teams meetings, any kind of phone calls, anything through the computers. Typically what we do is we plan for computers to be obsolete in terms of their speed and everything every 3 to 4 years. It depends on how fast the software technology is, on how fast that things refresh themselves, and the capacity needs for us to store things. So we're putting money aside for, in a rotating basis, every 6 months to have those computers replaced over pretty much a 4-year period. Things happen, people drop things. You're going to have to be ready for those unexpected things. Sometimes people's computers are still doing fine and it can last an extra 6 months or a year. But to all of a sudden be surprised that you got to lay out, $10,000 or $20,000 when you may be in a cash crunch for other things that come up, it's well suited to be prepared for these things. And then focus on ways to be more efficient. Look for tools that you can invest in that will help your productivity or reduce time to produce things. Software, equipment, changing driving routes if you're in a trucking business so you can save on gas costs, wear and tear on your vehicles. Marketing tools to help you identify and monitor where your business is coming from. That leads into something that we'll be bringing up in one of our later sessions is how to use technology to track these things. We're going to have a person that is very skilled, not me, but somebody who's very skilled in that area to help us on some of the software that's available out there and to help you be able to track these things and use them to gain traction on attracting people to your website and things like that. Carl and I, maybe we're part of the older guard and we've had to keep up with technology here and using computers, and we're trying to keep up with the younger people in our firms and everything like that. But at the end of the day, I still feel very comfortable taking a pen and putting it to a pad and, like the old rock and chisel. But we're human beings and we have some habits, but if we can keep up with these kind of things, we'll be much more productive. I've learned things from my sons that have gone through college now that have made my life easier, and I had to admit it. That's the fun part. Carl, can you now talk about some other things in our business regarding insurance needs and knowing when to what we need and what levels we need them in, and how that may be different in different businesses and different industries.
Of course, John, thank you. And needless to say, I will not be the technology expert either. So being CPAs, we have our area of expertise, but that's probably not it. So right now, I'm going to turn to insurance in general. I know John alluded to the health insurance questions that we had in our own organization, and we're not alone. Obviously, health insurance is a huge cost and a huge issue for businesses and families of all types, no matter how well you're doing or not. So it needs to be evaluated annually for sure. In addition, other insurances that often get overlooked and maybe not looked at as often should be, because there are several reasons. One is this year you might be paying too much money. Secondly, you want to make sure that all of your exposures are adequately covered, because in the insurance business, and this is a saying some old insurance person told me many years ago when I was very young, said, in this business, what you don't know can hurt you really badly. And I think that's exactly true. So we want to make sure, and you want to make sure, that you're covering the major exposures that could really cause a problem for you and your business, aside from the everyday stress and strain of just keeping things going and maintaining success. So that involves, say, looking at your insurance for your buildings to make sure the coverage keeps up with the fair market value or replacement cost. If you own a building, you also want to make sure that you're not covering the value of the land, because if the building happens to burn down, obviously the land is still there and it can be redeveloped. That's sometimes something that we see, although it's a lot rarer than it used to be, but it is a factor to, I think, keep in mind. Inventory levels may be a lot lower this year because sales are down. Maybe there's a way to adjust your insurance premium in that way. Or if you're sitting with a lot of inventory that you couldn't sell and it's a higher level than it typically is, again, you might want to make sure that it's fully covered, because if there's a loss and it isn't, not only you have the money you laid out for the inventory, but that's all gone as well, potentially. If you're in a business like ours, or some kind of a profession, a CPA, a wealth manager, an attorney, or any other business where you're giving advice, errors and omissions insurance or malpractice insurance is an important thing to have, because our society, as we know, seems to be ever more litigious, and we really do need to make sure that we're covering ourselves. Business interruption insurance is really important too, as many of us found out with Sandy a few years ago up in the New York area, which is where I was living then. Also, there are other types of coverage that could help with other natural disasters, any civil unrest, and pandemic insurance possibly, although I suspect the price of that is probably going to go up dramatically after this year. Key man life insurance, if you have an employee that's really important to your business and suffering the loss of that employee in an accident or by any other cause can really hurt your business, it could be very worthwhile to look at life insurance on that person to at least provide cash flow to tide you through until you can replace them or find another way to fill the role that they are filling. John, I know, has a story about vehicles in a client that he's been working on, and I'd like to turn it over for him so he can relay that to you.
Yeah, before I talk about the vehicles, that is a funny story. The other insurance that sometimes we forget about, but is become modern day a very critical issue. It is for us, especially with anybody who maintains customer or client records, is making sure that you have insurance for cybersecurity attacks. That is a critical area that everybody, especially with everybody being on computers today, it is one of the biggest expenses we have is basically computer fraud insurance, things like that. We do a great job in many ways to secure our clients' information and integrity. But in this world, anything is possible, regardless of the redundancies, off-site protection, and everything else. And this goes for any company that has client information. So keep that in mind. In terms of vehicle insurance, I've worked with all types of businesses, and one particular one was a very, very large trucking outfit that did dump trucks, large contracting around the country, multi-million dollar business. And when I first came on board, they had a small claim for one of their truckers getting into an accident and hurting somebody. Now, luckily, they had a decent amount of insurance, and a person wasn't hurt that bad. But the reality is that they had all their trucks under one company. What we decided to do after doing a little bit of homework is I came up with, through working with their professional attorney, came up with the idea of putting each of their trucks in its own separate limited liability company. And up front, they came up with a volume deal to put all these trucks in there. They had hundreds of trucks, I think it was at the time. And although it may have cost initially like an insurance policy money to set up, they only had to file one tax return called a multi-member LLC. And with that, they were able to insulate any accidents that happened with a truck, which are on the road every single day. If, God forbid, they got into an accident, they had insurance on the trucks. But anything above and beyond what they had on the insurance for the trucks that they had, they wouldn't be able to sue the rest of the fleet and take those assets away from them, basically wiping out the company. So there are many things that could be done that are creative and illegal and are asset protection, while at the same time morally trying to protect and have enough insurance on each of the vehicles. This can apply to many people, whether we're in real estate or not. Please call us and have any questions about those things. We can always talk about that after line. These are the kind of areas that is where you find the real value in work with professionals, that you find spending any money on them is a true investment, not only for your peace of mind, but for your pocketbooks. So that's my story for now.
Okay. With that, we'll get to the final section, which is retirement plans and how to evaluate which one is best for you. I will take up the beginning part of it, and then John will fill in the rest, and we'll review the options and what types are best for you given the various stage of business and what condition you're in and what kind of flexibility you need. And here we go. IRAs, of course, everyone probably has heard of them. It's a very basic plan. Doesn't take a lot to fund it. If you're under 50, right now the limit is $6,000 per year. You can also put a similar amount away for a spouse. If you're over 50 years old, you can put another $1,000, so $7,000, and that can be funded up until you file your tax return. It's suited for a small business just starting out, have a little bit of extra cash, don't want to go to the trouble and expense of establishing a more complicated plan. The next step up would be a SEP IRA, which is for businesses that have a small number of employees, and you can contribute. As you see, the maximum contribution limit is much higher, very similar to a 401k plan, which John will talk about. And in fact, I will turn it over to him now to discuss those additional plans and how they might work best for you.
Well, thank you, Karl. Depending on where you are in your business life, where you're just starting up, you're in a maturing, period where you're going through some growth. Where you have growth first, then you have a maturing period where you've done well, systems are in place, cash flow is improved, or you're at the last 5 or 10 years before you maybe either sell the business, pass it on to somebody else, whether it's the employees, whether it's your family, whatever it is. There's going to be different stages. And the use of these retirement plans are going to depend on the makeup of your employees, what they call your census. And that census is made up of the type of employees, the roles that they play, the ones that you find most important and critical to the success of your business. When most people are starting out, they're investing most of the money in the infrastructure of their business, and they don't have a lot of money left over, possibly. So they typically focus on an IRA. If it's a small business that is focused on primarily family members or maybe one key employee beyond the family members that start the business, they may want to use a SEP IRA. The reason a SEP IRA may make sense there is simply because whatever the percentage is that you put in for yourself, you have to use the same exact percentage, and that is of your salaries. So the SEP IRAs are typically best suited for very small businesses with mostly family. If you have beyond that and want to save around the same amount of money or even a little bit more, and you don't want to be able to pay out to every level of employee beyond just family members or key employees or other owners for that matter, that's when you want to jump into what they call a qualified plan. Qualified plans are typically 401k plans in business, and they're coupled with a profit sharing plan if you have excess cash to be able to get there. So in those types of plans, they're best suited for businesses with employees beyond family members. And the contributions to those, which is a contributory plan, means it's up to each of the individual employees on how much they want to contribute. In many cases, in order for the owners to be able to contribute the max, and many times they utilize a tool called the safe harbor method. And what that means is they have to put in so much into it for their employees as a percentage of their salary, just let's say up to 5%. So the first 3% is matched dollar for dollar, then the next percent is matched to 0.5%, and then the following percent. When you get up to 5% is another 0.5%. So on the very first 5%, you'll be able to match for your employees effectively 4%. That then entitles the owners to contribute even more and get up to the $57,000. If they happen to be over 50 years old, unlike the SEP, which is capped at 57, they can actually contribute a catch-up provision to try to catch up on the retirement savings of an extra $6,500 in 2020. If you're doing extremely well and you have excess cash of just, let's say, $50,000, $75,000, or $100,000, then you're going to want to consider a cash balance plan. And a cash balance plan is a plan that is basically 100% contributed into it by the business owner. In many cases, it can be designed depending on the employees and their ages. It can go up to 95% in many cases, maybe a little bit higher in rare cases, especially if it's a very small business with a husband, wife, child, and things like that. But you could put upwards of close to 100% into the owner's hands. When that happens, you get a huge tax deduction, which we're going to talk about shortly. So the migration here is what's key, is to know when to move from an IRA to possibly SEMP, or jump over the IRA directly to a 401k plan, and knowing when to add a profit sharing element to your 401k plan, which is just really just a rider to that plan. It's not a separate plan. And then when you have excessive cash flow, which means that you want to fill up the retirement plan bucket to dramatically reduce your tax burden currently, so that when you go to take out this money later in life and you're retired, you're deducting things today in today's tax brackets. Let's just say you're the high tax bracket of 35 or 37%. There's a high potential chance statistically that you will be at least in a 10 to 12% lower bracket when you're retired. Assuming that that's the case, the plan itself can be very flexible in design if you're working with people who understand how cash balance plan working in tandem with 401k plans can contribute collectively, save not only the $57,000 or more if you're over 50, in addition to the money you can save by adding the cash balance plan. Your taxes can be reduced dramatically, and that money will always be preserved. Let's look at the actual tax consequences on the next page. Well, here we go. Thank you, Karl. Well, in an IRA, if you can only put in so much money and you're in the 37% tax bracket, that savings could be a little over $2,200 by putting away $6,000. If you're put money into a SEP IRA, that $57,000 at 37% is $21,000. Still a fantastic, deduction in real dollars. If you jump up to the 401k plan and you're able to also do the profit sharing plan, if you're over 50, which you're not able to do with a SEP, you're able to save about an extra $2,400. If you jump up to a cash balance plan, the tax savings can be typically anywhere from $36,000 to $118,000. If you combine that with the 401k plan, you're talking about, if you go to the top of both of those levels there, in excess of $140,000 could be saved. That is huge for people that are doing very well in their businesses. The key is knowing when to change. Well, none of these things come for free. However, some plans, because of the simplicity, because of the limitations on how much you can deduct, are not that expensive to set up. But this is a facts and circumstance situation, and it's dependent on your unique circumstance, which is where the professional can come in and help you weigh these things out. But an IRA and a SEP is very, very insignificant costs, and if those pertain to you, they're $25 a year, which basically means they're inconsequential. But if you're in a situation where you want to be able to put a little bit more money away, or the facts and circumstances are beyond just family members, now it may cost you a couple of $1,000s to set up. But every time you set these things up, any of those costs to set these things up and maintain them on a regular basis are tax deductible at the same rates that you saved on taxes for contributing. You're also going to be able to save that money a little over, well, it's going to be 37% of whatever it costs you. So if a plan costs you annually around $3,000 or $4,000 in a very small plan to set up and go forward, it's really only going to cost you about $2,500. If you go to a cash balance plans, which are a little bit more complicated, they may cost a little bit more money to set up one time, but then the ongoing cost, depending on what the assets are in these plans, could be anywhere from $2,000 to say $10,000. But it all depends on how much the assets are in these plans. But regardless of that, you'll still be saving over 1/3 of whatever it cost you. And this would only be done if it's going to benefit you. So these are the things about retirement plans that you need to sit down with your wealth manager and your CPA. Not all CPAs have extensive knowledge in cash balance plans. Some do, but we are there and ready to educate them on this. I teach this around the country to other financial advisors because it's something with my background as a CPA that I've really enjoyed, trying to help people keep more of what they make. That concludes like the technical aspect of today's situation, but I do want to tell you one story about retirement plans. About a year and a half, I got a call from one of my partners and one of our clients in the Boston area. And that doctor was making significant amounts of money, and they had a 401k plan that was helpful. So he was saving around like $20,000 to $22,000 a year at the time. But when we got in there, we found out that there was no suggestion about a cash balance plan. And on top of that, they didn't design anything other than a off-the-shelf plan for the profit-sharing plan. What we went in and did, and it is looked at the underlying census, the employees that were involved, who they wanted to make sure they can get extra money to, effectively like a bonus, and be able to write this off. And on top of that, be able to plan for the future to be able to transition the ownership from the older doctors to the younger doctors. So we used this and designed a cash balance plan that not only gave them bigger tax deductions on who it went to, but it also wound up being a buyout tool, and without the younger people, the doctors, having to put up cash up front. Just more money went to the doctors. They got bigger tax deductions. Everybody was happy. Those circumstances mean that you have to sit down, know the nuances, calculate tax projections for these people. It's not just about finding a cookie cutter plan. It's about the design and the consultation. That's why it's so important to have the right professionals that you're working with that communicate, that Karl brought up much earlier. So what we'd like to do is open up for any additional Q&A that may have come in. And we can kind of go over those now. Karl, have you seen anything in that Stacy's been able to share with us, and maybe we can answer some of their questions?
Well, there are 4 questions that we've had, and thank you for being patient to those of you who have asked them, because we'll get to them now. First one is from Tom, and that is, can I take a loss on equipment that has broken and is unfixable at this point? So I would say yes, you can, as long as that piece of equipment still has book value, which means it has not been fully depreciated yet. There are some accelerated depreciation methods available, and in many cases, depending on how much you spend on that piece of equipment, you may have already recouped all of the cost as a deduction in your business. And if that's the case, then you would not be able to take a further deduction. But to the extent that it still has value on the books of the company, you can definitely take the loss on it. And that's something, of course, you want to confirm with your CPA, but that would be the answer there. John,
Okay.
Susan has a question, and she
Okay.
asked, what is a good percentage of income to have? And I believe this is in regards to a level of cash reserves, because it came through when you were talking about cash. So would you like to help her out with that one?
What percentage of income should be held in the business? Is that what I think the question is?
It's either in the business or personal, but maybe you could address both sides of that because they're really both important.
Absolutely. I think inside the business, you should be looking at it in terms of what your recurring expenses are, and then try to have at least 2 months of cash in the business at all times, or at least accessible in an account that's liquid. You don't want those things fluctuating and putting that kind of money in the stock market or anything like that. That's money that's liquid for reserves that are ongoing. You may be able to put money, there's some ways that you could talk about us offline about how to keep it so that it makes a little bit of money, and in today's rates it may be even just 1%, but it's still liquid. So I would suggest that you try to have at least 2 to 3 months, depending on your business and the consistency of your income and how it comes in. And some of that may have been tested this year with this pandemic. It depends on what kind of business you're in. But I would also really focus on trying to get a line of credit, a business line of credit that is available to you. And worst case, a personal line of credit that may be available to you that you can always put into the business if you need. So while you don't need it, it's not causing you interest. And when you do need it, if it's for a short period of time, 2 months, 3 months, 4 months, 3 weeks, it doesn't matter. You can have that. In terms of being on the personal side, that's our individual wealth management planning. We typically just came out with some of these guidelines for our individual clients. And we typically say that if somebody is working and has a very stable job, we tell them to try to have up to 6 months of cash reserves for things that happen for household reasons or emergencies of expenditures. So if you're spending $4,000 or $5,000 a month, you may want to have $25,000 to $30,000 sitting in some kind of high-earning interest account right now online, and you can get that with some of the online banks that are right now only paying around 1% or a little bit over that. So the Federal Reserve Chairman Jeremy Powell said that basically interest rates are going to stay low for the next 2 years. Well, that's terrible for people who count on interest, but it's really good for business owners because the rates are going to stay low. So that's a good time. Hopefully that gives you a bigger parameter. If you need some more, details and I need more information to help you on that, please feel free to email us afterwards or give us a call.
Well, low interest rates are another factor too, and that makes the borrowing costs very low. So if you're financing equipment or doing any other things for your business in that regard, you can probably get the money pretty inexpensively these days and lock it in for a pretty good term.
Sure.
Like John said, a high yield savings account is pretty much a misnomer these days because, we're seeing well less than 1%. And if you're in a regular bank or a money market, it's pretty much close to zero. We do have a couple of more questions. This is from Lee, and he asked if you could deduct a home office. And the answer to that, of course, is you can under certain circumstances. Although, John, you may know this. I'm not sure if anything has changed because of the pandemic, because essentially if you're locked down, you might be forced into your home office, in which case you would meet a test, which is it's required. But I'm not sure if there's been real guidance on that. I'd like to ask you to elaborate a little bit more, if you might.
Well, it's funny you bring up this question because about a year or so ago, I was dealing with my 3 sons. One was a sole proprietor. He was not incorporated. And he was able to take his home office deduction because it was his primary business, and he was able to do that. And basically what you do is you take, there's some safe harbor rules that they came out with just a few years ago. I don't know the exact year it came out, that said, if you don't want to keep any records, you could take a flat percentage, and I think it was like 15%, but don't quote me on that. But if you have expenses that wind up being more than that given amount that you can just say, I'm going to take the easy route, you shouldn't take the easy route if you can get more of a deduction, is my point. And if you have things like mortgage interest on a house or rent, utilities, cell phones, electric, any of those kind of things, you're able to take a percentage of the home. Now, if you were in a corporation, it's a different story, and that's something that I had to refresh myself on. And what you have to have there, which is actually very simple to implement, but it has to be effective for the beginning of the year to make it worthwhile for you. And you have to fill out a document where if you email me, I will tell you what you need to do, and it's called an accountable plan. And all it means is that you will reimburse yourself and act like a business in a corporation, typically like a S corporation or a partnership. And what that means is that you've committed to reimburse yourself on a regular basis. You're going to keep records and for these types of expenditures, and then you'll be able to take that percentage of the business that you wrote, that you use in your home as a deduction. So when you're in an S corporation, you just can't fill out a regular tax form or put it on your sole proprietorship. You're going to be filing typically an 1120S, which is an S corporation return, or a partnership return of 1065. And with those types, you're going to need an accountable plan. But to put that in place, it's really simple. You just have to type it up, and I can send you a template on what I've used. But I'd like you then to go to your CPA and maybe use their template that they maybe want to tweak. I'll just use a draft of what I use for my sons, and it's working with their CPA.
Thanks, John. We had another question from Lee, and it's COVID is a penalty abatement ? Which I guess means, are there penalty abatement policies in place because of the COVID pandemic? I know for payroll taxes, there's not penalty abatement, but there is an option to not remit payroll taxes, at least for a period of time, which is essentially a short-term loan, but the liability never really goes away. Can you amplify that?
No, I think you're right on point. I don't know all the details on that. That's something we could look up or coordinate with your CPA. But in terms of the liability would not go away. Karl hit it right on the head. All it was is a postponement. The government knows that people that are in certain businesses that they literally shut down didn't have the cash flow or potentially didn't have the cash flow. So what they wanted to do is give them that opportunity to have the time to rebuild their business, reopen it up. Let's make believe you were a restaurant or any kind of business that was effectively impacted by this, so that you have time to not forego the ultimate payments and not avoid any future penalties, but not have any late penalties right now in terms of when it would be due. I don't have those dates, but that's something we can always look up, or that your CPA or accountant should be able to help you out in terms of the time.
John, that actually almost sounds like what I said you shouldn't do, which is not remit your payroll taxes, because the liability is still hanging over you. And if business doesn't turn out or turn around as quickly as you hope, that liability could come due and you still might be caught short of cash, in which case then I would hope there's a penalty abatement that I could get, but I don't know that one exists at this point.
No, I was just assuming if they just purely didn't have the cash. If you do have the cash, you should either set aside and don't touch it or remit it. And especially by the deadline, which I think where the real issue is here. There will be penalties if you miss the extended due date, is all I'm saying.
100%. I just wanted to make sure we were clear on that for everyone else.
We're on the same page. CPA.
There is one other question, John, that we have, and this is from Lewis, and it's regarding gifts for clients. Is there a limit on the amount of the value of a gift you can make to your clients?
I don't know if there's a specific amount, but I do know there's a substantiation rule, which means that if you're giving gifts, like in our business, for reasons beyond the IRS, we can't try to influence our clients to give us more business or anything by giving them gifts. We do socialize with them. We may have a dinner with them or a lunch and things like that. But in terms of giving gifts out, I think it just has to be substantiated of a reasonable amount. So, for example, if you're a real estate agent and you go help them, close on a home or something, and it happens to be your son's home, and then you say, as part of that, you give a gift of a pool or a sauna or something, and you've basically given up your commission, I think that they would frown on that. But in terms of a dollar limit, that's something I think I would have to look up. I don't know those answers off the top of my head. It's like everything else, they don't want to have an abuse of that and get write-offs for things that are really personal?
I think you kind of touched on it, John. I think the problems come in if the gift is so significant,
Right.
it could be considered an extra inducement for someone to do business with you,
Exactly.
as opposed to an act of appreciation for the business that you are doing. And it's a gray space, but it certainly has been challenged and can create problems if you're not careful. Like, as John said, in our business, we have more regulatory requirements rather than legal limits that we're worried about. But, and I would not make sure if you are subject to some type of regulation, you would want to make sure you check that with your attorney or your compliance expert to make sure that you understand how that might affect your ability to make gifts to clients as well.
Okay.
I think that's it for the questions that have come in. John, I guess we have a few more minutes. If anyone else has a question they'd like to send into the chat box, we'd be happy to try to address it.
Yeah.
And if we can't address it fully, we'll be happy to get back with you and provide you with more information.
Yeah. Karl, can you go back up to the previous slide? I want to just tell them what's coming.
Yes. Before we do that, though, in the bottom right corner, I do want to remember to point out again, if you look at the bottom right corner of this slide, you'll see there's the link for the free resources that we have posted on a specific page for attendees of these St. John's webinars, and we appreciate being able to work with St. John's and with you to bring information of value to you. So that's right there, and it'll be available. So now, John, here you go.
Okay. Thank you very much. By the way, I want to just reiterate what Karl just said. I am very appreciative that I got my education at St. John's University, and in many ways, this is a give back. Sometimes people come to me just due to our expertise and my firm's expertise, and working with people like Karl makes it so much easier to collaborate within our own firm. So we're very blessed in that way, and that's why we do these things. The upcoming sessions that will be coming will include wearing the right shoes to the dance, which really relates to making sure that you're in the right entity at the right time. What's the best entity for you at this stage of your business cycle? And when should you switch, or should you switch? Next thing we'll also cover is, are you prepared to cash in? Positioning your business ahead of time for a sale or succession. As far as we are concerned, every day should be the same. You should make believe that today is the day you're going to sell. If that is the day, when that day comes in, you've already positioned it. Many small business owners do a lot of things in cash in some cases, and because of that, they're keeping their business under the table, and then they can't substantiate it when they want to be able to sell it. So we'll go over all of those things. How far ahead should you plan? We'll be talking about whether it's a 1-year, 3-year, 5-year goals in terms of budgeting, planning, sales goals, and how to work backwards so that you achieve those goals. And then we'll get into much more detail about how to monitor those things and prop those things up, which today I only alluded to. And I think in our last session in December for this year, it's up. Are you up to date with marketing trends and using technology and online presence? We'll have another person from our firm working with me to help out on these issues to make you stand out in the crowd, stand out online, and be able to find you easier and make sure that the design of what you're putting out there is attractive and intrigues people to ask more questions. Last one here that we're going to address in a formal session is a time to put down your rock and chisel. And that's what I alluded to earlier about Karl and I, is being up to date with technology and social media to update and fast track your business. These are the kind of things that as you progress, if you're not growing, you may be dying. And you have to keep up with where people are looking for services and goods. And in many times right now, they're at least, even if they do go to stores or walk in your office, they're going to look for you first online in many cases and read the reviews. So you have to have ways for people to give you feedback. And of course, that forces us all to be on our best game. So these are the kind of things that we're going to be touching upon, from leadership skills in the first session today about taxes, best ways to improve your business success, talking about retirement plans to reduce your taxes, and then these areas that we just covered. We invite your questions even after the session's over. You'll have the resources to identify us. You can reach us by our email or phone numbers. We look forward to these next sessions, and we wanted to tell you, and Stacy will reiterate this, but our next session and the continued sessions will be on the first Thursday of every month. So next month, that will actually fall on November 5th, next Thursday. Plenty of time for you to continue to look into some of the tax issues that you have now, which is why we went over taxes a little bit earlier in these sessions. So you have time to talk to your CPAs, call us up, set up a scheduled appointment. This is all free to you right now. You're not a client, but what we're trying to do is give you the guidance on knowing what things you should be addressing. Thank you so much for tuning in today, and thank you, Karl, for working with me on this session. I think that helped people ask more questions, and we thank you for your questions. Thank you, Stacy.
Thank you. And thank you, everyone, for joining us today. And a special thank you to John and Karl for sharing their knowledge. For their full bios, please go to stjohns.edu/CF webinars. Here you will also find a schedule of upcoming webinars and past recordings. I hope you will join us next month, Thursday, November 5th at 6 p.m., where we will continue our special edition series for small business owners and discuss how far ahead should you plan in business. In the meantime, have a nice evening. Thank you both.
Thank you.
Thank you all.